This this video will work through problem 3.9 from Gapenski's Healthcare Finance 6th edition. Okay, so 3.9 asks us to build the revenue section of Integrated Physicians and Associates income statement. And it provides us with gross patient service revenue, contractual discounts, charges for charity care, and estimated provision for bad debts. So it used to be, in the good old days, that the top line of your income statement would be gross patient service revenue, which in this case was $975. I'm going to just drop the zeros for now. Call it $975K, right? And so $975,000 is based on the charge master values, right? The undiscounted, non-discounted values that the organization would be sending out in terms of bills. But the reality is, and everybody knows this in the industry, that what we bill isn't what we collect. It's in fact typically a far larger number than what we actually collect, because physician organizations, hospitals have contracts with insurers that basically the insurers say, we'll pay you, some percentage on the amount that you bill, or, we're not going to pay that. We're just going to ignore your bill and tell you what the allowable amount is. But the fact of the matter is, the contracts that you have with your insurers as a provider organization dictate what you actually collect. So the contractual allowances reduce the gross patient service revenue. So in this case, we're taking $250,000 in contractual allowances. And then we also write off our charity care of in this case, $100,000 from the gross. So these are all subtracted. So I'm putting them in parentheses because they're negative, right? So these are all subtracted from the gross patient service revenue to get to the net patient service revenue, or NPSR. Patient service revenue. I'm one step ahead to the base patient service revenue, net patient service revenue, next step. So I'm getting a little ahead of myself. Okay, so we start with the gross patient service revenue. This is what we actually send out in terms of bills. We have contracts with insurers that reduce the gross patient service revenue by $250,000. And then we have charity care. So these are people that cannot pay, but we provide the care anyway. And that brings us to patient service revenue in the amount of $625,000. Okay. Patient service revenue becomes our top line of our income statement. So when we start to create the income statement, the top line of the income statement is patient service revenue of $625,000. All of this occurs prior to us starting to build the income statement. At least the current standard is we don't have gross patient service revenue as part of the income statement. It's not wrong, but it's just really not really done anymore. So patient service revenue, $625,000. Then we have the provision for bad debts of $50,000. And so then we have our net patient service revenue, which I slipped up and said earlier. That is our net patient service revenue, $575. Okay. And that is the revenue portion of the physician and associates income statement based on the data that we have. Okay, so that is part A. Part B. Suppose the contractual discounts and allowance balance reported above is understated by 50,000. In other words, the correct balance should be 300,000. Assume a 40% income tax rate. What would be the effect of the misstatement on the Integrated Physicians and Associates 2015 NPSR, total expenses, including income tax and net income? All right. So if I'm going to restate, I'll just start this again. So we had gross PSR of 975, contractual allowances of, instead of 250, it's actually 300, and then charity's correct at 100. Our PSR is 575. Okay, so the answer to the first piece is we have an overstatement of our, well, then NPSR, we have, so to get to our NPSR, we have bad debt is still 50. And so NPSR is 525, right? Versus, so 525 versus 575, right? It's that 50K difference delta from up here. So NPSR is overstated by 575. So so that's, let me see, that's the first answer. What's the effect on net PSR? Is an overstatement of 50,000. Total expenses, including income tax expense. Okay, so really the only information we have here, we don't have any information about expenses other than we know how much income the organization was going to report. Excuse me, revenue. So the organization overstated its revenues by 50,000. So if we have revenue minus expenses equals taxable income, and we are up by 50 and other expenses stay the same, then we have 50,000 more in taxable income. And if we're paying a 40% tax rate, 40% of 50 is 20. So we overstate our taxes, or excuse me, we overstate our expenses by 20,000 because of the additional amount of taxes we would have paid based on the $50,000 in excess income that we're reporting. And the last one is net income. So net income would be revenue minus expenses minus taxes, right, would give us net income. So if we have plus 50 minus no change here, minus 20 in excess taxes, we get plus 30 net income. So we would have overstated our net income by 30,000.